How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the Real Option Training Academy. And let's get right into it, right? So what we're going to talk about is how Equifax sent lenders inaccurate credit scores on millions of consumers, right? And this is something that we've been talking about for a long period of time. So the whole premise of my argument is that credit reporting is identity theft, it's fraud. It's a system that is not designed to be accurate because inaccurate scores, which can lead to a derogatory report or a report in which is incorrect because it's inaccurate, it allows the lender to charge consumers higher amounts on loan products, also higher amounts on insurance products. Therefore, they make more money. The providers don't have to provide accurate scores or accurate information to continue their relationships. Therefore, there is no incentive in this particular business model to make sure that the information that is being transmitted is actually accurate. And we're going to get into another example of that. We don't have just one example of this. We have multiple examples over extended periods of time of this taking place. And this is why I say that I don't have an issue with people doing what they need to do to make their credit score look the way it needs to look, because I can't trust the score anyway. I cannot trust the information that I get back from many of these providers because they have shown a lack of desire to make sure that the information is right and exact. Let's get into it. So here's an article from the Wall Street Journal, August 2nd, 2022. Equifax provided inaccurate credit scores on millions of U.S. consumers seeking loans during a 3-week period earlier this year. According to bank executives and others familiar with the error, Equifax sent erroneous scores. Let me zoom this up a little bit. Equifax sent erroneous scores to people applying for auto loans, mortgages, and credit cards to banks and non-bank lenders, big and small, according to these three particular banks: J.P. Morgan, Wells Fargo, Ally Financial. The scores are sometimes off by 20 points, and they were enough to alter the interest rates consumers were offered or to result in their applications being rejected altogether. This is exactly what we talked about. This information, right, raises the interest rate, which means what? You pay more. Bank doesn't care if the information is incorrect. Why? Because they can charge you more money. Therefore, what incentive do they have to make sure that the information is correct or the application gets rejected altogether? So therefore, the information can be so incorrect. The bank can say, well, you know what? We don't desire to do business with you because we don't feel you're a good candidate for our business or for the particular products that we sell. And you're not understanding what's going on because you have a belief that my particular credit history is XYZ, but the information that the bank is being provided is separate. Let me explain something to you that a lot of people don't talk about. When you're going to these financial institutions and they run your credit, the information that they get is not always the information that you get when you go directly to, annualcreditscore.com and you reach out to these agencies and you get a particular report from them. It's not always the same information. And one thing I encourage people to do is that when you go and you get a loan or you apply for a loan or you apply for a bank product and they say, we got your report, request from them that you get a copy of that report. And what you'll find out often is the information that they're receiving is different than the information that you're getting from these providers. It's an old story about back in the day, right? The old school record companies would keep 3 sets of books. They would have their own internal books. They would have the books that they would use to file their taxes. And then they would have the books that they gave to the artist, right? So everybody would get different information. The only information that was correct was the information that the record companies was keeping for themselves. And that's how they kept everybody in the dark, because they kept so much misinformation in the environment. The actual artist never knew what was going on because the record company would tell the artist, we lost money on this project, but in reality, they really didn't lose money. They really made money, but they're going to tell you they lost money. So you never worry about trying to figure out how to get money out of your deal. You think you're always in a recoup stage. Bun B talked about on the interview was that when you sign a record deal, you never know how much money the record company makes off the deal. You just know what they're paying you out. And until you get savvy about that particular situation, you don't even know what to look at to determine how much money they make. This particular system is very similar. When you go file for a bank product, you go file for a mortgage, and sometimes also when you go file to try to figure out whether or not you can rent a property from somebody, they go to these particular services and they get information back. That is not always identical to the information that you're getting if you go directly to these services, if you go to annualcreditreport.com, right? However, it should be, but it's often not. And that's why I want to encourage you. If you get in that situation, ask that particular person, can I get access to the report that you've given? A lot of us are just worried about a yes or a no. We're not worried about making sure that particular information is valid and correct in regarding our particular profile. Let's go to the next paragraph. So we have determined that there was no shift in the vast majority of scores during the 3-week time frame of the issue, said this particular president at Equifax U.S. Information Solutions, right? And he says that for the consumers that did experience a score shift, they said analysis says that only a small number of them may have received a different credit decision. So this is the issue. It doesn't matter. Well, see, small number is relative, it's subjective, right? So if I'm talking about 1 million people, a small number could be 50,000, right? If I'm talking about 10 million people, a small number could be 1 million. So the actual language that he's using is all subjective. A small number. What is the number? Out of the actual accounts that were incorrect, how many do we think got a different credit decision from a numerical standpoint based on this? And therefore, the way he frames it, it doesn't allow you to really understand, right, what is really going on, because he's using language that is not actually based on something that can be quantified. So Equifax maintains credit reports on 200 million U.S. consumers and sells them to lenders, right? So they have 200 million different files, right, on these U.S. consumers, and then they sell that to lenders, which is their business model, right? Let's go to the next paragraph we highlighted. The percentage of incorrect scores provided to lenders varied. The people said at one big bank, 18% of applicants during the 3-week period had incorrect scores with an average swing of 8 points. Of those, several thousand saw a change of 25 points or more on their credit score. In a small number of cases, applicants went from having no credit score at all to having a score in the 700s or vice versa. So in a small number of cases, still relative number, applicants went from having no credit score, which means you don't have a credit score, to not having a score in the 700s. When you have people that had a score in the 700s, then now you got a 0. So now imagine to where you know that your score is in the 700s. You go to try to get a bank product. They say, we got to run your credit. And now they come back and say, well, you know what? We don't trust you with this bank product because you don't have a credit score. You're like, well, I know I got a credit score. Well, now you don't have a credit score. We got this piece of paper saying you don't have a credit score. Now you got to go solve this problem. The problem wasn't created by you. The problem was created by this particular business. But now you got to figure out how to solve the problem. Now you got to get back in contact with this business. You know you cannot call these people on the phone. Everything when you try to call them on the phone is all through a robot. It's almost impossible to get to a live person. So what do you got to do now? Now you got to play the snail mail game. Because if they're telling you you don't have a score, there's no way to go on their website and to file that I don't have a score when I went to this particular institution. So now you got to probably go to the CFPB. You got to wait for that particular process. But like I said, you now have to do the work for this business when it should be their responsibility to make sure the information that they're presenting is right and exact. The most widely used credit scores range between 300 to 850. The higher the credit score, the more likely applicant will get approved at a lower interest rate. So we talked about that before. Mortgage lenders sought about 2.5 million credit scores in the period in question, according to the industry estimate. But because they typically view credit scores from each of the 3 credit reporting companies, the glitch may have been blunted, some industry official said, right? So that's pretty much going to be that article. Now, what I want you to understand is this. I don't trust Equifax evaluating their own errors. I don't trust them. And there's an incentive for their business to downplay the rate of errors and the impact of the errors. Why? Because they need the public to believe that they should have confidence in this credit scoring system. The banks don't care if the information is incorrect. Why? Because they can charge you more for the information being incorrect. Once again, we have a system that's built on providing inaccurate information, providing information that is not reliable. It benefits the banks in selling their bank products. It doesn't matter to the data furnishers because they are not, in any way, this information is not detrimental to their business because it doesn't matter what they present. They're allowed to do their own internal investigations. They're allowed to fix things within their own time period, within their own timetable, and the system keeps rolling. And I think this is an issue. And this is why I don't really trip on people trying to do things to make their credit report look a certain way because the whole system is fraudulent. Therefore, if Equifax, TransUnion, Experian are engaged in identity theft and engaged in fraud, why would I be upset that other people came about to do the same thing to them that they're doing to everybody else? I'm not justifying it. I'm not saying you should do it. What I'm saying is I don't see the issue, right? To me, this is a bunch of scammers trying to figure out how to out-scam each other. Just because Equifax, TransUnion, and Experian are publicly traded companies, it doesn't mean that they're not scammers. We have multiple incidents of them being engaged in things that I will believe to be fraudulent. They haven't been charged of anything. Why? Because it's going to take the government to go after them. You as an individual are going to have an almost impossible time dealing with these particular organizations, and they lobby to the government extremely aggressively to ensure they can continue to do business the way they do business. So that's going to be the article. If you got any questions, hit me up in the comments. David W. Williams, also known as Diamond Dave. I'll talk to you later.